Welcome to Commercial Real Estate Pro Network's CRE PN Radio. Thanks for joining us. My name is J. Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today, my guest is Omni Casey. Omni has been a real estate investor, broker, and coach for nearly 20 years. He invests in small to mid-sized multifamily cash flowing real estate from Virginia to Hawaii. And in just a minute, we're going to speak with Omni about investing in cash flowing small to mid-sized multifamily properties. But first, a quick reminder, if you like our show, CRE PN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We love to hear from our listeners. Also, if you'd like to see how handsome our guests are, be sure to check out our YouTube channel. And you can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest. Omni, welcome to CRE PN Radio.
Happy to be here. Big fan of the show. Thank you for having me on.
I'm really looking forward to our conversation today. But before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Absolutely. So my story started in Hawaii. I'm born and raised in Hawaii. That's where my family is. Grew up there. Fairly entrepreneurial family. Father owned construction, roofing businesses. My mother had home-based businesses, and allowed them the flexibility to kind of create a life that by design. And my mother homeschooled us, and that's something that she wanted to do. There's 8 of us kids, so it sounds crazy for someone to want to homeschool 8 kids, but they were able to do that because they kind of controlled their income and their time there. And I didn't know what I wanted to be when I grew up. I just knew I didn't want to be an employee. They kind of set that mindset for me. Real estate wasn't really a part of the discussion or picture, but I did love business. Fast forward a few years, found Rich Dad, Poor Dad as a book, and realized, okay, business is what it is. And eventually got into the real estate side of things after a few other businesses, and got in as a real estate investor, and then became a broker, coach, trainer, over the last 20 years as well, helping real estate agents and our clients invest as well. So that's been my focus, and that's kind of how I became Omni, the investor guy, for the last few years.
Awesome. And I'm sorry, how long did you say you've been investing?
About 20 years now.
20 years. Okay.
Yeah.
And did you start in multifamily, or did you start in single family, or what asset class
I
did
did
you
not.
start?
I took a very meandering path. Probably I probably tried every single type of real estate investing there is. Started out with whatever I could afford, and I had no money, so I couldn't afford much. But lucky enough to find the right partners and the right really mentors as a young kid that was willing to guide me or let me tag along for the ride and learn. So started in Hawaii on the condo side of things, and quickly realized that Hawaii was outpacing my available cash flow or available funds, and learned how to invest long distance. And so I've done condo rentals, short-term rentals, multifamily. I've done wholesaling. I've done fix and flip. I love the BRRRR strategy. I've done mixed use. So I'd love to say I picked one path and stuck with it for the last 20 years, but I've dabbled in just about everything.
Got it. And for our listeners, and kind of get some perspective here, you currently now focus on the small and the mid-sized, or small to mid-sized multifamily. I'm curious, what do you define as small, and what's the differentiation between small and mid-size? What's the
Great
size?
question. And I don't know if it's the official definition, but how I define it, small multifamily is 2 to 4 units. That's the residential side of multifamily. And that's really defined by the debt that you can put on that. The 30-year fix is much easier when you're in that space. And then anything over 5, and I say 5 to 20 is mid-size for me. And basically things that you can take down by yourself. I invest just me and my wife. Got 3 kids, so we don't have a big company by any means, and we don't take on many partners or syndications or things like that. So things that we can do within our scope versus taking down a 300 unit building, you typically need a big syndication or some sort of fund to be able to do that.
No, I hear you loud and clear. That's kind of the mirror of what we do. So let's talk about the cash flowing. A lot of people, they get all excited about real estate. There's definitely tons and tons of upside, uh, from all angles. I mean, the tax advantages, the asset accumulation, the cash flow. But I'm curious, from your perspective and your experience, when you acquire properties, are you able to experience cash flow from day one, or how do you find that starts, and or when do you find that you're most likely to have your positive cash flow start?
Yeah, absolutely. So the cash flow side of things is, I kind of define investors in one of three categories. Cash flow is that second tier, that cash flow investing for financial freedom. The income is really what you're looking for. The first tier is someone that's doing it as a profession. That might be a broker, that might be a fix and flipper, a wholesaler. But that financial freedom aspect is really cash flow dependent. And then the third category I put as generational wealth. Once you maybe don't need that cash flow or that financial freedom, then you can do bigger things that are probably more tuned into equity appreciation, path of progress, and things like that. And so I do all of my investments in one of those three categories. And that helps me at least to just clarify, all right, not every investment is going to be across the board, everything. And so when I focus on cash flow, I go all in on the cash flow aspects of it. And I typically do find something that is either already rented out and I'm able to inherit tenants or a few tenants as well, or really the majority of what we do now is what we call portfolio repositioning. And so we actually buy portfolios from small mom and pop shops. And so someone that's been doing it for the last 20, 30 years, and they're thinking about it, ready to exit, they're depreciated, all their assets down to zero at this point. So they're not seeing the same return. Average mom and pop that we work with is anywhere between 10 and 20 properties. And those properties are mixed between single family and small to mid-size multifamily. And the reason I like this, one, it's a different strategy than most are working on. And it allows me to scale that up at a higher volume versus buying one at a time. That's a lot of transactions to deal with. But if you look at it from the perspective of a mom and pop portfolio landlord, they typically have great investments and they have some headache investments, right? And there's a mixed batch of them. We all have that, right? We all have, like, if I could just get rid of this one, right? But unfortunately, if they're thinking about exiting at some point, they're like, I could definitely exit my good ones. I'm worried about exiting and being stuck with just my bad properties or my headache properties. And then the other option or obstacle that many of these landlords are coming up against is, at some point they paid off debt, or maybe they bought them cash, and then they decide to pull out equity. But maybe they're smaller properties and you can't get a loan on just one small property. So they say, let's just do a portfolio loan across my entire portfolio. And they're cross collateralized, which is great for many people until you try to sell it. And often you can't sell one property at a time. You have to sell your entire portfolio, because every single property is, collateral to that bank, and they want you to sell them all at the same time. So not many smaller investors are able to go buy an entire portfolio. So we try to position ourselves where we buy out these small to mid-sized portfolios all at one time. And then we reposition them because we are willing to buy all their good properties and their bad properties. Clearly, we don't want to keep the bad properties. We either want to fix them up, make them better, or sell them off, And so in a typical portfolio, I would say somewhere in the realm of 60+% we actually keep as long-term rental properties. And then the rest we look at development, wholesaling them off, or fixing them up and actually selling them out. And so we keep the best parts of the portfolio. It's a lot more work, but compared to buying a 100-unit apartment building, you can't really just go sell off one of those or two of those, bad units there. So it allows me to be a little bit more hands-on and really create the value in a very difficult, process that there's not a lot of people in that space.
No, I like the approach. Because like you said, the portfolio loan, if you have everything cross collateralized, it does make it a little more difficult to exit, and you would be a solution there. Let me ask you, in the intro there, I read how you invest from Hawaii to Virginia. Are you employing this strategy with the mom and pop nationwide, or do you try and focus on an area that you already have a footprint?
So the last few years, I've been trying to focus more in my area. I'm in Northern Virginia now. So I've said the last 5 years, I've really put a heavy focus on buying more in this area. And not because it's the best place to invest. I believe you could be successful investing in almost any market if you understand what you're looking for and you'd employ the right approach. I have 3 kids. 13 is my oldest, my daughter's 9 and 7. And I started to, although I've been talking about this for a while with them and they understand it on paper, I really want them to have this financial education. I didn't have things to point to, things to take them to. And so most of what I do now, a huge percentage is in the Virginia, Maryland, West Virginia market, somewhere within a 2-hour radius of where I am, specifically so I can keep my kids involved.
No, that's great. I was just talking with an investor yesterday about how he had employed his kids to help with some janitorial duties, and he was talking about just some of the duties they were getting involved in, and some of the early lessons in life. It really does make you
Absolutely.
appreciate some of what hard work is, and that's good. So your strategy, basically, are you finding? Let's back. How are you marketing or finding these um, sellers that you're able to work with?
Yeah, the reason, so I guess starting out, it was the same way that everyone marketed, right? It's direct to seller calls, texts, emails, postcards, build broker relationships. One of the reasons why I became a real estate agent and broker, I'm licensed in 5 states. I don't actively sell myself, but I coach people doing that. One of the reasons I got into that space was so that it's one less, barrier of entry to find these leads. And so that was the traditional way. I would say, since I've established myself in several markets, and once you find a really good team, whether it's a real estate agent or property manager in that area, they become your main lead source. So a huge percentage of my business comes from my existing property managers. My goal when I'm connecting with a property manager now is to not have them manage 1, 2, 3, 4 property. I want to be their number one client. And I actually asked them that, like, what would it take for me to be the most important person on your books? And they tell me a number, and I figure out, can I, achieve that at some point? But my goal is for at least my rock star property managers to be their number one client. And once you make that commitment or get there, every single other person in their database or clientele, they don't want them to sell it to anyone else. They would rather sell it to you, so they know when the mom and pop is ready to exit. They know before anyone else. And rather than going to the market, they say, well, let me introduce you to a guy. I think he can help you. And so I get warm handoff leads from my property managers more than anything.
No, that's great. I mean, you've kind of stepped ahead of the competition, and before you make it a competitive situation, that's great. And also, I think one of the things that I think that not everybody understands is that selling a property is not always easy, and there's a lot of tire kickers out there, and you can get beat up quite a bit as a seller. A lot of the market is full of people that are ready to work you down, kind of thing, and
Correct.
if you, especially if you're a less sophisticated seller, maybe you've been doing it on your own and you're not um, as clued in, or you're not as aware of what you have or whatever. It's easy to feel like, oh yeah, it does have this, it does have that problem, does and um, just succumb to the pressure as opposed to just have a chance to deal with somebody straightforward. And that's, I'm assuming that you probably that a lot of the sellers like working with somebody that they've been referred to as opposed to just going out in the open market. Do you find that to be true?
I think they do. And not every seller is the right fit for us or for anybody, right? Some sellers need to go to market because they need to get max value or whatever the case may be, and they have time, right? They have 3 years to parse out their portfolio and sell them off one by one, and that's probably what they should do. For those who, whether there's time constraints, like they got to sell out 22 properties in the next 30 days, right? And it has to be sold to one buyer. There's not many buyers out there that can do that. You put it on the MLS or CoStar, wherever, it's tough because most buyers are not looking for that, because they're going to look at the portfolio and say, well, you got some gems in here, but you have some dogs in here as well. Can I just buy the gems? And no one wants to inherit the properties that they don't really want in their portfolio. We're willing to absorb them all and just know that we're going to parcel those out and eventually offload them to the right buyer that specializes in that type of property. So the mutual connection that I typically have with the people I'm dealing with is we both employ the same property manager, and it's usually a great property manager that we both love. And so we already have this mutual connection of that person must be smart because he hired a person that I did as well, right? So we have that connection, and it usually works out well. Not everyone falls into the category of people we work with, but we're typically able to help them on the brokerage side as well. Like, so if I can't buy it, then we'll help them go to market and sell it as well.
No, I didn't think about that. So the broker option there is definitely powerful there. That's good. So when you acquire these properties, whether they be portfolio or individual properties, do you look to buy and hold? Or are you trying to reposition them and sell them? What, talk a little bit about what your big picture plan and how you operate with your acquisitions.
Yeah, that's a great question. And I keep revisiting, and I've adjusted strategies over the years, and I get asked quite often. It seems like the next step for everyone is to start a syndication or a fund of some sort, right? If you get good at investing, and it makes sense to kind of go bigger and bigger and bigger. And the one reason why I've never done that is I don't like the requirement to reposition and sell in 5 years or 7 years, because most of those are tied to some sort of balloon debt of 5, 7, 10 years, where you have to make a decision. And obviously there's value there, and that strategy worked for some. My strategy is, if I can buy it and never ever need to sell it, then I'm okay with that. Not to say I don't sell properties. I absolutely do sell properties, but if I can buy it and never ever need to sell it, then that's a safer investment for me. And I'm buying it, for that cash flow aspect of it. And so when I purchase, and the reason why I'm staying in this space is I'm typically able to, I usually buy cash most often, and then I reposition and I refinance, do what's called the BRRRR strategy, maybe fix it up a little bit, add some value, and pull out some equity on 30-year debt for that property. So that's my goal, is to put 30-year debt individually on most of these properties. Some of them we group together, and the ones that just absolutely don't fit, then we either redevelop it all together, or we sell it off to another investor, or a buyer that wants to just live in that single family home and it just didn't fit our portfolio.
Got it. So you mentioned that you do you don't raise capital and have any outside investors. In the initial there, you or the intro there, you talked a little bit about how you started in Hawaii and kind of realized you ran out of capital. How did you overcome, or what is it just been a matter of momentum that you've grown your portfolio large enough, been able to refi and cash flow enough now that you have enough capital to go out and buy these? Or are you getting any kind of creative finance strategies, or how are you doing that?
Great question. And it is something, maybe all of the above is probably the best answer. I wrote a book a few years ago, never actually published it. Actually, I'm publishing it this year, the Cash Flow Breakfast Club. And it kind of put my story into it, right? Of what I've done. And it really is stacking. It's buying these small little incomes. And then I've been really good about not I think most people, the more money they make, the more they spend. Like, all right, I'm at this income bracket now. Now I need to go buy a bigger house. I'm at this income bracket. I need to move to a different zip code, right? And so I think I've been able to convince my wife, is probably my biggest feat, of not have that income lifestyle creep with our investment income increases. And all we've done is put that into an account and just recycled it. And every single year, we're just buying more properties and buying more properties. So it has nothing to do with any active income that I have. It is my properties by my properties. And over time, they've built up cash flow funds that we're using. And then clearly, as appreciation happens, if we're able to refinance them, they still are positive cash flow. But now we have equity that we're using to buy other properties. That's been our main strategy. So we do a lot of what's called the BRRRR strategy on the residential side. On the commercial side, it's just like a regular repositioning or taking down a building. But typically in a 6-month period, you can add value to the property, rent it out, raise the rent, or put a new tenant in there, and refinance out upwards of 75% on average of the new higher value equity. And often that's everything that you put in, purchase price and renovation. So you get your money back in about 6 months. And the end result is you still have a property that's bringing you in cash flow every single month.
Yeah. No, that's great, and I think the thing I've learned most of that is speed. If you can get in and get your renovation done as fast as possible, and get somebody in there and get those higher rents, that's really kind of the key, as opposed to some sort of lingering project that takes longer and more capital than you intended. That's kind of a slow death, or at least a painful situation. So, gotcha. So if you were to identify or or say this is an ideal opportunity, what's an ideal opportunity for you?
Ideal opportunity is a portfolio. It's a landlord who really needs to sell, wants to sell, maybe has tried to sell in the past and just could not find the right buyer. The majority of what I buy is still small multifamily. So if someone has 20 single family homes, I'm typically not buying it from them. It just doesn't fit my strategy, cash flow strategy, and portfolio. But we might have other investors in our group. We currently created a mastermind group locally where people are doing similar to what I'm doing, but maybe in other asset classes. But someone that has a portfolio of duplexes, triplexes, quadplexes, up to 20 units or so, that's the ideal buyer, because we can typically pay more than most buyers out there as a whole and let them exit at the exact entire time. And you mentioned sometimes there's creative strategies involved. Sometimes there's seller financing involved, because they take back a note, and then that allows us to pay even a higher price up front because our lending costs or our out-of-pocket cash cost is much less.
Well, that's one of the things I love about the whole real estate opportunity is the limits are basically your imagination a lot of times. So it's good. Hey, Anna, if we could, I'd like to shift gears here for a second. By day, I'm an insurance broker, and I work with my clients to assess risk and determine what to do with the risk. And there's 3 strategies that we typically consider. We first look to see if there's a way we can avoid the risk. If that's not an option, then we look to see if there's a way we can minimize the risk. And when we can neither avoid nor minimize the risk, then we look to see if there's a way we can transfer the risk. And that's what an insurance policy is, risk transfer vehicle. And so I like to ask my guest if they can look at their own situation. It could be their clients, investors, tenants, the market, COVID, however you would like to frame the question. But take a second and identify what you consider to be the biggest risk. And for clarification, while I am an insurance broker, I'm not necessarily looking for an insurance related answer. And so if you're willing, I'd like to ask you, Omni Casey, what is the biggest risk?
That is a great question. And I think there's a lot of little things you can point to. You mentioned environment and what's going on in the world, how that might affect your individual asset at the time or your strategy at the time. But my answer is probably a little bit more broad, because what I found over the years, no matter who's in office, right, no matter what's going on in the world, you can be successful in what I do in real estate investing, and you just got to be willing to change your strategy when you understand what's happening there. So I think the biggest risk is really not understanding the rules to whatever game you're playing. Like understanding the rules is so important. And some people don't even understand the game. So maybe not understanding the game. And then like what I'm doing, you could actually choose to play a different game, right? There's a very common game out there. I'm like, well, if I can get good at my own game, no one's actually in my space playing the game that I'm playing. So I don't have a lot of competition. So it's actually much easier for me because I created the own rules to my game. Once this picks up, then maybe I got to go figure out how to create a new game. And so when you're looking at some constants that we think are constants and maybe they change, how does that affect, for example, a lot of talk about inflation, right? We're north of 7% and who knows where it's going to go. But that's a rule. That's a rule in the game. And if, I use the analogy of gravity quite often, like if gravity changed today, if for whatever reason, gravity was at 50% and people like borderline started to float away, we would have to change the rules to how we live our day, right? We'd probably have to wear heavier clothing and not jump around or whatever the case may be, but we'd have to adapt and get used to it. And so 7%, 8%, 10% inflation is crazy, but as long as we're adapting and we know what to do, we have to invest differently. Like my investment decision today is different than it was 5 years ago based on inflation. Same thing with insurance. Same thing with interest rates. If the interest rates continue to rise, all right, that changes my strategy. My strategy is drastically different, but understanding that all they are just rules to the game, I got to shift what I'm doing. So it's really a self-analysis of what your goals are, what you're doing, and understanding that everything that's going on around you are just rules to a game. If you understand them, you could use it to your advantage.
No, that's a great way of looking at it. It's a game. And I think that to me, that's a way more healthy way to look at it than it's not fair. The child expectation that it should be equal for everybody, as opposed to being able to identify what the opportunities are and how you could take advantage of it. I think that's really well put. So I appreciate that. Omni, where can the listeners go if they'd like to learn more or connect with you?
I have a website. It's omnitheinvestorguide.com. So they can find me there. They can find out information about the book, a lot of the free training and coaching that I offer. There's links to it there as well. I am mostly on Facebook and Instagram. Same handle, omnitheinvestorguide.com. Against my will, I have a TikTok account as well. I don't do any dancing on there, but my publisher said that's something that we got to have as well. So anywhere, if you just Google Omni the Investor Guy, you can pretty much find me.
All right. Well, we will post that in the show notes, and I encourage any of our listeners to check you out and learn more. Amna, I've enjoyed this tremendously. I can't say thanks enough for taking the time, and I hope we can do it again soon.
I look forward to it. Thank you very much.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.